presentation contains current opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compak Asset Management YouTube update for April 30th, 2021. I'm Mo Ansari, President of Compak Asset Management and host of Market Wrap, the daily one-hour broadcast that is syndicated nationally. You can get that daily broadcast simply by clicking on the link in the box below. Looking at the markets, let's start with the pandemic. No, I'm not going to call it the pandemic update. I'm going to call it the recovery update now. That's where we are. We are recovering from the pandemic and we're well on our way. I'll talk about the U.S. markets, where we are, and then, of course, the technical analysis. I'll take a look at the weekly charts, the daily charts, the weekly charts, and the monthly charts, because today it is the end of the month, so we'll take a look at some of those charts also. So I'll look at the technical analysis. But let's start with the recovery update. That's where we are. The pandemic is just about over here for us, fortunately, in the United States, but when you look at it around the world, it is not a pretty picture. But looking at the recovery, we're looking at the infection rates coming down. We're looking at the mortality rates coming down. And now anybody who wants a vaccine can literally go. You don't even need an appointment in a lot of places. You just show up, get your vaccine, and off you go. That's where we are. We are the #1 nation in the world and get the vaccinations done. India has, even though it has 130-40 million people vaccinated, but they have 1.4 billion people. And then they have the new variant right there, the B.1.617. That's different from the B.1.1.7, which is the British variant, the UK variant. The B.1.617 is what is called the double mutant. It's got double mutant. It's got two different variants in there, and it is a mess in India right now. People don't have enough oxygen. All the beds are full. You can't get into a hospital. It is just a mess. And as of this afternoon, the president announced that, the White House announced that they've shut down travel from India. No one can come from India, which I was surprised. I talked about it during the week, that I was surprised that we're still letting about 20-30 flights a day coming in from India to the United States. So I think we had to shut that down, just like we did from Brazil, which is another hot spot in the world, because again, they just let their guard down before they had enough people vaccinated. And now they are going to try, but it's going to slow down the recovery for the rest of the world, especially the emerging markets. Looking here, we've got about 234 million people vaccinated already. Johnson & Johnson is back there. And surprisingly, people like the Johnson & Johnson because it's only a one-shot vaccine instead of the two shots. Pfizer, 21 days after the first initial shot. Moderna, 28 days after the first initial shot. But with the Johnson & Johnson, all you have to do is take one shot, and it gives you a very good immunity. We look at the excess deaths, they're even below than what they were pre-pandemic. So we're looking at people are we are looking at all the excess rates coming down. So we are getting the pandemic under control, but it is looking at the economic data here in the United States and in China. Today we did get the China, their manufacturing data came down a little bit. Our data is definitely looking very good, but European data shows that they're sliding into the second recession. They're going back into recession because, again, they botched the vaccination process there. They will catch up, but they're about 3 or 4 months behind. And then we have emerging markets like India, which is the third largest importer of oil in the world, for example. Could take as long as 6 months before they can get it under control, but the world is starting to help them. We're sending in, I think, about 20 million doses of the AstraZeneca vaccine, which we had here. It was not approved here, but it is approved for use in Europe, so we're sending that to India. We did get great earnings this week. You saw the earnings from Apple, you saw the earnings from Microsoft, you saw the earnings from Amazon. Amazon did get above the 35.52 area, got to 35.54 today. Could not quite hold it. New all-time intraday high for Amazon. Their earnings were just incredible, and they expect it to continue. Everybody was expecting a fall off in Amazon earnings because everybody was home ordering everything from COVID because of COVID, but the Amazon is saying nope, they expect this growth to continue, which is definitely a very good sign for some of these large companies and the earnings. Even though the earnings came out, some of the stocks came down for these companies, which I think is good, because if the price stays where it is, the earnings goes up, the PE ratio, the price divided by earnings, comes down, and that's what we really need to see, is some consolidation here. And I talked about it in March, before we got to April, where March was sort of a market was in the doldrums, and I said, well, I think we could get to about 42.35 was my target for the S&P. Again, these are my views. These are the way I was looking at the markets technically. We got to 42.19 this week. That's pretty close to my target of 42.35 by the end of April. And now we get into the summer months. I know a lot of people are saying we will continue. As we continue to reopen, I think some of the reopening trade will continue to do well. But earnings did come out. They're blockbuster and they're looking very well. Also, we saw a surge in household income. That was up by 21% in March. That is the largest gain since 1959. A lot of it, stimulus checks accounted for about 3.95 trillion out of the 4.23 trillion that we saw growth in. A lot of it was due to the stimulus checks of $1,400. So now the money is coming through. It came from the government. It's in checking accounts, and we're seeing a spike in spending also. It was up 4.2% month to month. How long will this spike last? Once we dissipate this initial surge of money that was sent out by the government, will the economy be able to hold up without all of this extra money? We are seeing people buying durable goods rather than buying stuff. They're buying cars, they're buying furniture, they're buying durable goods instead of services, which means that this is something that could last for a period of time. That is the biggest question right now. This initial surge that we are seeing could be revenge spending, as I called it, or revenge travel, where people have just been stuck in their homes and said, look, I'm free, I'm ready to go, let me go and travel. I think we'll see more domestic travel within the United States, going to Europe, going to other countries. I think still will not happen as much, even though European countries are saying they will open up for people who are vaccinated. But I think it's not weird. I don't think people are ready. But we could see a surge in domestic travel. We could see a surge in car travel. That is why oil prices did very well this month. We went up to nearly $65 a barrel in oil, even though India is the third largest importer of oil. The demand for summer driving season here in the United States and demand for oil is expected to rise dramatically and offset the demand drop that we see from India. So I think we are looking at, when you look at the recovery, initial jobless claims, the level we're at is 547,000. Pre-COVID, we were 224. So we are coming up very, very strong. Jobless claims are still about double where they were, a little bit about 2 million higher than where we were pre-COVID, but we are coming back very strong. If you look at retail sales, up 13.5%, box office receipts, well, I don't think we're ready to go to the theaters, but theaters are starting to open. Real car traffic is higher than where it was pre-COVID. You're looking at steel production coming up very close. We're looking at TSA. We're still about 1 million travelers lower than where we were a year ago. So we are 2.3, we're at 1.3 right now. So that's what we're looking at. Supply for gasoline, demand, pretty much there. We're down about 3%. And then commercial flights, we're still down about 32%. So we are coming. We're not there yet, but I believe in the next couple of months we should be there within the United States. Now, can we contain the virus? Will we get these mutant viruses coming over from India? As long as we have people vaccinated, people do not get affected, then the virus does not mutate. But when people are getting infected, that's when you get the mutations in the virus. So if we can get that. Looking at the technical picture of the market, 42.35 was my target that I looked at. We got to 42.19 yesterday, and today we fell off a little bit. Support now is around 41.47, which is the 20-day moving average. Then the 50-day moving average is right about 4,000. We are seeing a fifth wave here, and if we see an extension of this fifth wave, we could get to 4,400, but I don't know if we go there straight or we get what is called an ABC correction. When we see a fifth wave high, then we start what is called an A, ABC correction, and that could bring us down to 4,000, which will bring us down about 4 or 5% if we do get that over the summer. On the weekly charts, again, if we see an extension, we're in the third wave. We have not seen the fourth wave pullback. Fourth wave brings us to the 20-week, which is around 4,000 again. The third wave extension. Now, each one of these lines is 1 week rather than the previous chart where it was 1 day. This goes back to about 2017, about 4 years of trading for the S&P 500. If we see an extension, we could get to 44.75. I don't expect us to go straight up from here. We are seeing some divergences where the RSI made a high last month. We made new highs in the market, but the RSI did not. Same thing has happened to the MACD. So I think we are at a point where we have all the good news. We have all the COVID's relief money already in people's hands. We've seen all the great earnings also, reports also. Now we don't get those until next month. So I think we are going to go into the summer doldrums, and we might go back and forth for a period of time, but that might give you an opportunity to adjust your portfolio. Looking at the monthly charts, and this goes back to 2008, where we see each one of these lines is 1 month of trading rather than 1 week or 1 day. And you can see when we get to the top of this Bollinger Band, we sort of go along the top of it, and then we sort of come back to the medium. And this was the last year, the drop in 2018. Then we saw it come down in 2019. But we were right at the top of this band, and we continue to go. This is, again, a monthly, and this is a very long-term target. Hopefully we'll get there for the fifth wave, but before that's maybe 2 or 3 or 4 years down the road. We could see the third wave extension is again coming in around 45, 4,600, somewhere around there, but we might get a fourth wave pullback before we go on to the fifth wave. So this is a longer term picture that I continue to keep in mind. Where are we in the longer term wave count? And we're nowhere there. Here's the Nasdaq. Looks like we're getting close to the fifth wave. Target was right around 14,750. We did make new all-time highs this week in the Nasdaq. We did make it in the S&P. We did. So support now is the 20-day moving average, 13,925. Then the 50-day moving average, which is 13,500. Below that, we've got the 200-day, which is 12,300. Overall, the Nasdaq looks like it's still right here, closer to, this was looking like a fifth wave top and an ABC correction, and this was looking like wave 1, 2, and we're starting a new wave count. I don't know if we are. Looking at the weekly charts, we were going down for a number of weeks, then the markets broke out this about 4 weeks ago, 5 weeks ago, we started to move up, and now we're looking at, this is the long term again, weekly target. Each one of these lines is 1 week of trading. That's the way I'm technically looking at that. 14.4 is support, then 12,000, that's the weekly charts. Gold is stuck between 1850, which is the 200-day, and the 1744, which is the 50-day moving average, and we are just going back and forth. Every time that gold goes, interest rates go up, golds go down. There's a direct relationship. Everybody's looking for inflation to push gold up, but interest rates, if they continue to go up, which I anticipate will by the end of this year, hit 2% on the 10-year note, and if we do get to 2%, gold will have a very tough time going up. We do have a double bottom at 1675. If we break that, then the market could accelerate to about 1600 or even 1500 on the downside in gold. Oil, this is the emerging market chart. Each one of this is a daily chart. We are sitting at support at 54.05. We closed at 53.98 today, just below the 50-day. Long-term target is still looking good on the upside at 62. That's the long-term target for the fifth wave. But emerging markets are being hurt by obviously India and the virus continuing to spread in India. So we might see a slowdown in emerging markets, and they might not do as well. Here's the small cap index, which seems like it made a top, has gone through that ABC correction. Now it's starting a wave count, wave 1, 2 down, and we're starting 3 up. The target for the third wave comes in around 2,500. We're seeing a little pullback here to about the 50-day moving average, which is 2247. We close at 2266 today, so we're close to the 50-day. I think that would be an opportunity. If you're not in small caps and you want to, that's where the recovery stocks are. They're in the small caps. The mega caps, the big tech companies, they did well during the pandemic. They did well because the demand for their services and the amount of cash they had, they could survive very easily. It was the small companies that went out of business, the ones that have survived. As we reopen, the small caps usually do well, and that's a really area that I'm looking at. On a weekly chart, each one of these is 1 week of trading. We did come back, touch the 20-week moving average last week. This week, we sort of stayed up here. Again, first target is around 22, 24, 25. These are my views. This is my interpretation of the charts. Doesn't mean the market has to go there. It does what it wants to do, but you have to combine the technicals with the fundamentals. You have to do the fundamental work first. You have to do the valuation work first before you start looking at technicals. 20 years ago, everybody just looked at fundamentals. They knew nothing about technicals. Now we've come full circle. Everybody says, oh, look at that divergence. Look at that fifth wave. And everybody's looking at their charts rather than doing the homework on the fundamentals. You have to combine all of that technical analysis and fundamental analysis. Look at the global picture. Look at the global economy. Look at all the money supply numbers and what the Fed did and what the Fed said and what. But remember, we have J&J on our side. That's not Johnson & Johnson. That's Janet and Jerome. We have the two of them. That's Janet Yellen, Treasury Secretary, and Jerome Powell, the Fed chair. There we have J&J, and they are there to support the market and the economy. As long as they're there printing money and putting money into the economy, it goes to two places, the stock market and the real estate market, and that's what we've seen. That's my view. That's the way I'm looking at the markets. I hope you have a wonderful, wonderful weekend. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.